Good morning, everybody. Welcome to the Flow Show. Fun and games this morning, going on as usual. Lots to get covered over in the news and headlines. Morning, K-Man. How you doing?
Hey, good morning, Ryan. Good morning, everybody. Yeah, we are, let's say, wrestling through the day.
And it's only Tuesday. How's my mic this morning? Is it all right?
Yeah, very good. Yeah.
Cool. Good. Right, well, let's get stuck into things. Let's go over the data first. We'll leave the big event till last. Nothing much out yesterday afternoon from the US or anything like that. So it's been the overnight data and bits and bobs this morning. So a bit of data out of Japan. Unemployment rate coming in as expected, 2.6%, down from 2.7%. So good news there. Industrial production, though, continues to look a bit sucky. There was a bounce, but it wasn't as much as expected, 0.2% on the month. Some of the other numbers coming in lower than expected as well. Large retail sales on the month down 0.1%. there versus up to 0.2% previously, again on the year, but again lower. Year-on-year retail sales not quite as high as expected, still positive, but a little bit less than last month as well. So a little bit of mixed bag data. Yes, mate?
Can I straight away say, I mean, if you look at those numbers in, well, I mean, first of all, the job market is still very, very tight over there, which is normal, which has been for a long time. But these IP numbers, look again what they expect for next month. The 2.5% was what they expected last month for this month. It's been constantly undershooting those expectations. That is something that we need to keep in mind. Yeah. Okay. And
yeah, it's
sales are expressed in Japanese yen. So if your yen tanks, your retail sales may be pushed up in value, but the overall value compared to other currencies may be less. But that is just an apartheid. But I was just wanting to highlight the IP expectations all the time for the next month. It rarely overshoots. It's a bit like your European consumer confidence here.
Yeah. Thanks, mate. And we know that sector has been a bit soggy, as we've seen in the PMIs, not just in Japan, but around the globe as well. And PMIs is what we're going to move on to next from China with the MBS. This is the sort of official number, if you like, PMI there. Manufacturing moving back into contraction, 49.5, so still not out of the woods there. Services as well moving backwards, was expected to gain a pip to 51.8, but came in softer as well. So it's maybe looking at a dead cat bounce in these numbers from China again, which won't help the cause over there. More data from Japan, household confidence, perhaps surprisingly moving up a touch there. Confidence on the ground and confidence in the PM, Kishida, hasn't been overly great at the moment, but that household confidence gaining there as well. Starts don't really look at, but a worse than expected number on that one. Coming into some of the Eurozone numbers, GDP numbers popping up as well. For France, coming in as expected, 0.1%, matching expectations, obviously lower than the prior quarter. Year on year, softer as well. Positive numbers still. Again, this is what we've been talking about. Numbers not really doing anything really great, not really doing anything really bad. You know, we're not seeing minus 5% GDPs or anything like that. It's all bumping along around the zero mark. Some input price data for Germany up a touch on the month, 1.6%. So bit of price pressure coming in there, possibly. Retail sales, though, still looking very soft as well. Down on the month, more than expected. Down on the year, more than expected. So still a consumer problem there in Germany. Inflation in France, again, flash numbers coming in as expected, confirming the drops from the prior numbers. Quite significant drops, really. 9 points on that one. 120 pips on that one. So inflation still going the right way, still not getting down towards ECB's target, but the direction is good, and that will keep the ECB on pause mode for that. Italy GDP, again, bumping along the zero line, coming in at zero on year and on the quarter. This is what things are going to be like going into the end of this year. Portugal as well, might as well take a look at there, a negative 0.2% on that one. CPI in Italy, this one is more down at target, and a big drop there. I haven't actually checked into these numbers. I don't know if you saw anything in these, Kay, that caused such a big move lower in inflation. I mean, that's huge in inflation terms, that move lower. Don't know if it's got anything to do with some of their programs going on, fiscal programs or whatever.
There is that, and then there is also I think in the southern part of Europe that it's much more volatile than in the call it the core or the northern part of Europe. Also have been traditionally, but yeah, I must say that I haven't honestly looked into the details for Italy either. Just saw on the sidelines that the Dutch numbers were also coming in on the weak side, and also on the GDP side as well, this morning. So let me recheck that quickly. Dutch CPI was actually negative 0.4, and on the year-on-year, and that's quite a big change as well, right? So yeah, that's I didn't see the GDP, but on the CPI front, it's also coming in quite negative.
Yeah, well, as I say, you have to ask our mate Magic's about the Italy number, see if he knows anything about that. But it's if these numbers are true, it's going to be, this is where some problems may arise, because obviously you've got the ECB setting rates for the whole of the Eurozone. Okay, so if you start seeing countries coming under, the inflation target for the ECB, these countries are the ones who are going to then start talking about rate cuts. And especially if we start to see numbers well below 2%, if we start seeing Italian inflation at 1% or something like that, these guys are going to be calling for rates to be cut. But if we're seeing heat elsewhere, it could develop into a bit of a bum fight between all the different countries' central banks and their influence on the governing council as to what they do with rates. It's all right setting rates for one country. It's a different thing setting rates for 19. So just something to keep an eye on there. If we start to see particularly the, Spain, Italy, France coming well down, but the Germans are still high, something like that. Anyway, that's probably something we're going to have to look for in Q1, Q2 next year.
And don't forget Lagarde's French. If in France it starts to move, then she's going to have to pick up the baton and have a fight with with likely the Germans and the Dutch. But the Dutch, as I said, Dutch CPI is coming off, so that is another one, and the Dutch are one of the core, right? That may be a sign. But anyway,
anyway,
Euro doesn't respond to it right now for sure.
No, definitely. It's getting dragged around all over the place. But as you can see there from the Eurozone GDP numbers as well, again, bumping along the floor, 0.1% year on year, minus 0.1% quarter on quarter. And I think there's not much for the Euro to get to negative over these numbers about. As I say, we're not seeing an outright collapse in growth. If that starts to happen, that's a different kettle of fish, particularly regarding rates. So, but you look at them, if you compare country to country, US versus Eurozone, if you had to if someone said, where do you want to park your money right now, you'd more likely park it in the US than you would in Europe. And that's sometimes all it can take for flows to move around. Not that we're seeing it in the exact price action today. Right, so other news in Japan. Kishida says that he hopes to boost the economy to ensure that the tax rebate can be a one-off. So that's what he's looking at with this move here, and that's played into what the Bank of Japan have said, or what UEDA has said after the meeting there. So they left rates unchanged and they tinkered around with things. The 1% upper band remains is it difficult because when they changed YCC before, it wasn't a cap, it was a reference point. And that's been extended now to 1% is a reference point. So it's not a firm line in the sand that yield can't go through it. It's a reference point of where yield shouldn't go through. They left the short-term rate unchanged at 0.1% and maintained the yield target around 0%. What they also did was scrap any reference to the daily fixed rate JGB purchasing operations. On the forecast front, which we all were looking at, they raised forecasts as expected. Fiscal year 2023 went to 2.8% versus 2.5%, not a little bit shy of that 3% mark. 2024, they raised quite significantly, though, from 1.9 to 2.8%. So that's the next 18 months, roughly, where they forecast inflation 8 ticks above target. 2025, however, they only raised it a pip to 1.7%, so keeping it below the 2% mark. And again, that was that formed part of the comments from UEDA as well. Now, the core CPI numbers, this is the XX, that got hiked in 2023 to 3.8 versus 3.2% previously. However, 2024 and 2025 still remain below the 2% level at 1.9 each. 2024 was up 2 pips from 1.7. 2025 was up a pip from 1.8. So there could be a bit of a, I call it the central bank accounting smoke and mirrors, where if they want to switch focus from headline to core to justify their calls, this may be something that UEDA is looking at in terms of saying that they don't see sustainable inflation, yet those core measures, stripping out all the volatile stuff, is still below 2%. Didn't mention it specifically, but it's what central banks do. We always get it when talking about inflation. They switch from talking about headline to the core and whatever to justify their positions. So anyway, on to UEDA. He kicked off saying that they will patiently continue monetary easing with these decided new measures. Did say the economy is recovering moderately and, as mentioned, expects inflation to slow in fiscal year 2025. That's a change. They were expecting inflation to slow this fiscal year 2023 before accelerating again, and that hasn't happened. So now he's kicked the can to 2025. Says that they can't see the inflation target in sight with certainty. Again, if there's predicting the next 15, 18 months of 2.8 inflation, how is that not above target with certainty? Anyone's guess. They said they're not in a situation to foresee a sustainable and stable price increase. On the YCC, it's appropriate to improve the flexibility of the YCC. They won't hesitate to take additional easing measures if necessary. It's possible to conduct additional emergency bond buying at 10-year yield levels below 1%. It doesn't think long-term rates will come under pressure to exceed 1%. Yeah, well, we'll see what happens with that theory. Today's steps came partly as a result of rising long-term rates. So as we've been mentioning, this is being spun as more of a market functioning move rather than a monetary policy move. However, he did concede that they are gradually getting closer to achieving their price target. That's probably the most hawkish thing we've heard so far from Ueda. And then moving the can to the government, says we'll scrutinise the effects of government's policy on the inflation outlook once it is announced. Then he went on to speak about effects, saying they considered effects as part of the potential side effects. Big volatility in Forex could have a negative impact on the economy, closely working with the government to monitor the situation. FX could affect policy if it impacts the price outlook. Also said we can contain speculative moves in markets with flexible market operations. So, Kate, what are your thoughts? It's the slow road, isn't it? They
Exactly.
keep taking a step towards easing. The market wants a hare, but it continues to get a tortoise.
Yeah, exactly. It's the snail's pace we were talking about, and again, it reminds me of those words that Ueda and the government said at the start of Ueda's taking the government the governorship of the Bank of Japan, is saying that they are going to closely cooperate, and I guess we are seeing another example of this is that. He keeps the monetary policy in place, then tweaks the YCC a little bit instead of making it a cap, making it a reference. Will likely allow to move above temporarily, and he made the reference as well to global yields, right? So again, as we a little bit feared yesterday, or fearing is a big word, but as we may have suspected, is that he uses the global yields as an excuse, but that brings it back to a very big disappointment for those who are expecting effective moves in the monetary policy, and that, as I said in the room when it was happening, despite let's put it that way. There's two things. There's this cooperation with the government, where they are going to try to keep the yields under control, because he did say that they are going to be flexible on JGB, but that means really that they can step in with unscheduled JGB buying every day if they want, around the 1% mark, for as long as the rest of the yields in the rest of the world are not flying. That's kind of how I read it. But then it does give us the next possible move towards normalization with the hike in inflation expectations. So the issue remains exactly the same as yesterday, or as when he took the helm of the Bank of Japan. How can you stay long yen for longer if every day you pay money away because they are keeping yields under control? So for us as traders, it's still either a conundrum. If you think that the rest of the world is going to fall apart around it, and you want to buy yen as a safe haven or whatever, you're still going to pay at least 3 to 4% away, or nearly 4.5% away every day for being long yen, right? And that is still hasn't changed. He hasn't given. That's what I said as well in the chat room when it happens. I said, rather than giving the yen bears something to chew on, of course we see the yen is much weaker. It's the yen bulls who have been disappointed again, and they have to leave the ship relatively quickly, and that's what we are seeing again today.
Yeah, and they've been double disappointed as well, because also the MOF released their FX update, and there was apparently officially zero intervention. So we've got a case now where we've got the Bank of Japan, who has taken a half step again, and it's not exactly what the market wanted. And then you've got the MOF saying they didn't intervene in October, which then gives some of the market the green light to take yen pairs higher.
Yeah.
But then on the flip side, you've got, yen pair long people were going to be worried. Well, if they didn't intervene back then, are they keeping their powder dry to intervene now? So the risk on both sides of the trade
Yeah.
are just as equal. You know, you got to be careful being short yen pairs. You got to be careful being long yen pairs. And I think it's a psychological game that they've injected into the market now. That's just got everyone trying to, you know, guess and second guess, and it's creating a bit of caution now.
Yeah, but you must. Wow, we must see that if you look at all the yen pairs right now, that they are losing the psychological game, right? Because the market tells them, okay, we are going to go until you tell us that it's really enough, right? But you're right in saying it's equally dangerous now to be long or short yen pairs, because I mean you buy it, assuming that we take the low of yesterday, 149.08, just to name the dollar yen, not to go into details about trade weighted index, because that's absolutely getting slaughtered again today.
Yeah.
Global yen pairs. But if you just take the dollar yen and you think back about what Kuroda was saying, that 200 to 300 points moves in a day are excessive. Now, the market is, if you take the low 149.08 yesterday or overnight, and that's 151.08 is your 200 points, and the prior intervention level around 152 is your 300 points. Now, if you're long yen crosses, don't go to sleep, right? Because they can take those words again and saying like, remember, this is an excessive move, and put dollar yen back at 147. That is equally possible right now. So it's a market where I'm very happy with what I have. Is my option again, but I know that not everybody can trade options, but I'm very happy with my option, because I'm going to manage it around. If they intervene, it's going to be fun and games, because I will have hedged already a little bit, which I'm in the process this morning. But I won't feel comfortable going long euro yen at 160.5, for instance, because Jesus, I mean, if they intervene, they can put it back at 156, and I will be looking at a 400 point loss. On the other side of the coin, people who will have bet on the Bank of Japan doing anything, or even today, are you going to go short euro yen or dollar yen at 150.70, or euro yen at 160.70? Are you really want to be short? Because UEDA doesn't give us anything to really buy yen on the back of, right?
Yeah, exactly. I mean, I think you can, because there's caution from both sides, increased caution from both sides. Like you say, no one's going to be buying dollar yen at 150.70 and thinking, yeah, yeehaw, here we come 152 with the intervention threat hanging over. But if you want to pick your levels and trade against these moves on the short side to get a pullback, you've got to keep it small. You've got to keep it tight, and you can't be too wrong. You don't want to be 50 pips offside and wondering what to do. You know, if let's say you want to trade the big figure here in euro yen 160, fine, 160, 20, 25, you're wrong. You know, you got to keep your risk low, but you got to be careful. If it only dips 10, 20, 30 pips, take some money off the table. You know, put it in the bank, reduce your risk, bring your stops down, and then you can ride a train and see what happens. But yeah, it's a tough one. I mean, look at dollar yen. It's matching those highs.
But on the other hand, if you're a long-term trader, you're likely short yen, right? And
yeah.
And now today you have been comforted in this kind of idea, and you also think that, for instance, that if they would intervene at 152 and they put it back at 147, you're probably still not panicking, because you know it's an intervention for the wrong reasons, and it's not because they are getting any help from the Bank of Japan. The thing would have been a lot more dangerous for short yen if the Bank of Japan would have moved and the market would have said like, well, sorry, we are still going to sell yen. Then interventions would have been a lot more dangerous, I think, for the more medium term. But in today's, if you're short long term yen, you find this meeting as a comfort meeting for yourself. Short term is a different thing. That's what we've just been discussing, right?
Yeah. Mike asks, do we believe the threat of intervention at 152? Well, we assume they don't put a number on it. We don't know whether they put a number on it here at 150 with this move here. Officially, they haven't. 152, 151.5. You can pick it. Again, we've probably got to go back to the playbook of volatility, and that's going to be the deciding factor. You know, if we go through this high through 151, then we're in that volatile scenario that we've always banged on about. So yeah, I tend not to put numbers on it unless they specifically say they're looking at numbers. You know, it could be 151, it could be 151.35, it could be 152.06. Who knows where they're going to do. What I'm going to do though is just set my sights a bit wider. Look at the longer term charts. This was a fib I was looking at when we had this move up here, the 38.2 big multi-year fib. We came up just short of the 152 area. This fib at 152.76. Above there, we've got 160. Just looking at the prior highs up here. So you know, there's levels above to look at. You don't want to get chopped around a bit in the noise here. Technically, on the short term, we may have finally broken 150. We got a little bit of let's go into this one. We got a little bit of support coming in just ahead of it after we had to move up overnight. So you know, it's doing what it needs to do, but it did that previously, moved to the high, and then we came all the way down again. So I think it's possibly significant at the moment that we've found the high again up at this prior level. You know, we've told about trying to pick tops. This is what you want to see technically. You know, if we drop a bit, come back, test it a couple of times, can't get through, then shorts have something to lean against. I think we need to wait for the US to get in and, well, they'll be coming in shortly actually, and seeing what they want to do with it. Maybe they give their reaction and give it a nudge up through the level. If we do just nick a high and then come back down a bit, that would suggest that we're going to be moving on up, and this 150 is likely to become much more solid as support, and then a potential base if you're not long to try along again, because you don't need to give it much room below 75.80. You're wrong again. So we've got a bit of a playground to play in here, and you can take it either side. So there is something for longs and shorts to consider here, but know the conditions you're trading in, know this heightened risk, possible intervention, so on and so forth.
Yeah,
right, as you said, I mean, yeah, and we still got end of. I mean, this, you know, this was we got a little bit of a nod in our room that there was some dollar yen selling yesterday, and that was a lot behind this move to the lows down here, and then it just took off afterwards on that front. So yeah, maybe we've seen the end of the main end of month stuff, but we've got that to consider anyway. I mean, what do you think if we got to move up here on the fix down to here? You've got to think about buying that, haven't you?
Yeah, I think so. If it's a fixing move, it's probably going to be countered after that. That's what I would say and what I would think.
Yeah, but then on the flip side, we're now moving into the FOMC orbit. So, you know, maybe that's a reason why we're just not pushing through these highs yet. Again, maybe some caution over the Fed event. So I think there's still two-way risk. We've had the Bank of Japan, it's done its thing. We've had a move, this continued to 152. Well, then you've got to take the dollar into the equation and what the Fed does. Are they going to pause, signify that rates are sufficiently restrictive rather than just restrictive, you know, firmly closing the door on further rate hikes? So don't take your eyes off the fact that there's two sides to the pair, and we've got plenty to do in the dollar as well on this one. Euro, as Kay mentioned, euro yen. I mean, euro yen, I haven't looked at all the yen crosses. Euro yen is the only one who's breaking new highs. You know, even Guppy and Aussie yen, they're not breaking new highs in terms of where we've been before. Dollar yen isn't breaking new highs in terms of before. So the euro yen is one that is. Why is the euro so big, Kay? Because even euro dollar is on its uppers.
I'm okay. Against the yen is perhaps a different thing, but I think there's a lot of end of month in there, and combination of likely euro shorts on the back of the data, all getting pushed towards a mildly painful exit, in my opinion. Yeah, I think it's a combination of end of month, and we've seen now for 3, 4 sessions in a row that the euro is beat, especially in the European morning, and then it's an extension to it into the 4 p.m. So there's clearly flows going on there. Um, as we've been discussing, and that's really the opinion is valid both ends. The euro is holding up really well despite very weak data compared to the US, for instance. But I guess, as you have said, or Mark have already said, it's likely already in the price because the market was expecting it. But if you look at the differentials on the economic data, I can't buy a euro. I really can't buy a euro at all. And for the time being, it's a bit of a painful watch. Well, painful. Okay, I'm got like really smalls in. So on the account side, it's not too painful. But on exactly where the price action is, it's looking a little bit painful because I mean there could be an extra leg there into the fixings later on today, which are going to take us to quite dangerous levels, whether it be on the euro dollar. The other one, even though weaker than the euro, is the sterling. And looking at the moves that we had there, they seem to walk a little bit together versus the rest. So
Yeah.
it looks like a bit of a non-Swiss European thing against the rest. So those who probably got hammered a bit the most are now recovering the most as well. That's the way I look at it. Yeah, much more than that I can't really say or even comment because
Yeah.
it's okay. I'm not sterling is one thing, but for the euro especially, I can't buy a euro based on the data that we are seeing now, especially. And as I said, I'm willing to look through some inflation stuff because I want to see the real data. But the real data are clearly not great in Europe as well. We're getting weak retail sales, we're getting slowing down CPI, and we're getting a negative GDP print. And compare that just to the dollar block, we're going the same way in the CPI now, where Europe was a little stickier before, recall, but the rest of the data is worse. The only thing where it's comparable, everything is holding up well, is still across the pond, is the jobs market.
Yeah.
Those are really big dominoes that continue to stand on both ends. But we know that the jobs market for the time being is still tight. So
And to
that
be fair, the job situation in Europe is pretty good as well. We shouldn't
yeah.
forget that.
Oh, yeah.
You know, we may be seeing some slowing economic activity, poor retail sales, but the jobs markets, you know, we're not seeing any massive unemployment jumps or anything like
No,
that. Things are still ticking along over there.
no, that is the thing where both are still like comparable. So that is not based on that. I mean, unless we start to see really deviations from one side or the other. And again, we are having the US labor report at the end of the week. Are we finally going to see something creeping in there? But we'll talk about that later, I trust.
Yeah.
No, so the thing is, there's a lot of comparable situations, but those who are diverging from one side to the other of the pond are clearly in favor of the US right now. So I guess what we are seeing now is end of month stuff and likely a bit of over positioning. I'm not yet going to put it on the back of the US Treasury thing because we are going to get more details and more important details tomorrow on the refunding.
Yeah.
Whether they are going to go more short term as expected than prioritizing the longer end of the curve up to now. That is going to be decisive or deciding tomorrow. Could actually, as I said, be a bigger mover than the FOMC actually. But so that is something. But if that would be the trade, then I don't understand why stuff like dollar Swiss is still high, dollar CAD is sticking, dollar yen is sticking, dollar China is sticking. You know, it's really a euro and a sterling move. This what we are seeing, and
Yeah.
that pushes me to think it's really month end and a bit of over positioning.
Yeah, and just on just to update people on that on the US Treasury issuance situation, they released their quarterly borrowing estimates for Q4, and it was getting a lot of attention in terms of expectations. You know, how much more would they need to borrow? Because obviously we're seeing a drop in demand for issuance. So obviously the more they issue, the lower the demand, the more problems it creates, and the higher potential yields investors want. So they were previously looking at 852 billion. Their estimate came in at 776 billion. So give or take 75 odd billion less that the market was expected. But you got to remember, you need a bit of context here, because that 776 billion is up some 50% of what they were doing this time last year. So it shows you that they're still, you know, borrowing a hell of a lot at the moment to fill those black holes. and as Kay said, how they split that up, which is the information we'll get tomorrow, how they want to target the different durations, could have an effect on markets as well. As we saw last night, yields coming down further on the back of that information there. So a bit of pressure off, because it means they're not needing to borrow as much as expected. But we still have to see where it's all going to go, and then how it all gets sold and what the demand's like. So this pressure on yields, higher yields, is not abating just yet. We need the finer details for that. Also, we had BOC's Macklin saying that further easing in inflation is likely to be slow, and inflationary risks have increased. If inflationary pressures persist, we are prepared to raise our policy further to restore price stability. The Deputy Governor Rogers said that the Governing Council has not started talking about rate cuts there. So a little easier talk from the BOC after that inflation number, after they turned a bit more hawkish prior to that. Not that dollar CAD is doing much, as it's caught pretty much in the whip around of what's going on there everywhere else. Still holding below this 38.60s area up here, which is a level ahead of my charts for a while. I think that's a bit of a make or break line for a run to 140. 138 is looking to be the sort of main support, again, prior highs that we've seen up there. So another bit of a tight playground for you loony players to play in. You can either play in between or go with a break either side on that one. Now, talking about cable and the euro, it looks like for once the euro is going faster than cable. Usually it's the other way around. Cable tends to move faster than euro dollar when they're both going the same way. As you can see, we're getting another push up, or had another push up in euro sterling. I'm still kicking myself about getting tucked out of my longs in that move there. But I'm still long from down below, so no harm, no foul. We're getting up towards the next zone for this one. Let's come out a bit wider. Let's go to 4 hour. So my next zone right in here starts off round about 85, 55, 60-ish. Bit of a traffic zone. Bit like this one down here that we mooched around in a lot. So it's not really... I'm going to look to take a bit of my other longs from 85s off if I see us failing up into this area here. But if not, if we travel on through, then we're probably going to be looking at 88s, at least this 61.8 fib of this move. But we need to see if it's contained, if it's sustained here. 87.20 looks just to be building a bit of support. Again, that's what a lot of us were looking for last time in the prior break. Might be getting it now, a bit of support coming in here. So again, if you're trading this one, look at this line here down to the big figure 86.90 as your guideline. If we're back under 90, we're undoing a lot of the moves again. If we're holding above this red line here, 87.1720s, then it keeps this move alive, and maybe we're going to get a further push higher. Horatio asks, end of month selling given an opportunity on the euro? Possibly. Pick your poison. If you don't believe, like Kay, that this euro bounce is sustained based on the fundamentals, then by all means go against it. Oh, excuse me. Kay, can you just take over, mate? Sorry, I've got to take this one.
Sure. Woo! What was that? That was funny. Yeah, that's the thing. If as Ryan says, if one doesn't believe in this euro move, there's going to be perhaps a few euro crosses that one could watch again, could watch as well, barring the euro. We know the euro. Okay, let me share my screen then. Let's move over to what we are looking at here. Okay, euro dollar. We're on the approach of the 107. So, sorry. Whatever happens, I mean, in what we're seeing in the price action now, what I always advise people in the room, keep an eye on the clock, because it could be that this euro demand is taking us right into the 4 p.m. London fix, and then all of a sudden the bids are gone and the bottom, I'm not going to say the bottom falls out, but we can see a pretty decent retracement in the euro at least. But again, I think it's going to be a case of watching this 107 now that we are back through this 106 35 45 in the euro dollar. If post 4 p.m. we start to trade below here again, then I think the party is at least temporarily over, and that it's really been end of month trading in this euro dollar, which I think to a certain degree is certainly valid. Ryan was looking at the euro sterling, so I'm going to yeah, that's the one here. Look, we are coming towards a resistance line here. That's the 87.55 zone. If we get through there, then it's probably going to have a look at the high 87s. But it is possible, again, as I said, that this is end of month. So if we start to get above, depending on the timing, we could fail and get back down. 87.20 is your level, but I would think that 87, the figure, is really going to be a bit psychological now. If we don't hold that, then it's probably going to go down. I don't have too much of a clear view on the euro sterling. If you want to counter trade it, technically it's not too bad, but I think sterling and euro are relatively walking together, with the euro being the stronger one now, because probably over positioning and end of month stuff, which was possible. But anyway, we're coming into reasonable levels here on the euro sterling. And again, if you look at euro yen is a bit too easy perhaps, but if you look at other euro crosses, we're seeing this end of month stuff, yeah, really kicked in Monday morning. We already had a bit of a taste of it on Friday. Asia put the euro a bit lower, so that's your Monday Asian move here. But clearly, euro is bid versus everything into the end of month. Okay, this one is of. I'm getting really very interested in this. I've got like really small tinies running in it right now, but I'm going to be looking at this zone here, somewhere up in the high 167s on the euro Aussie, with one eye on the clock, another eye on the picture. If we fail up here and then start to come back below this trend line, then I'm going to have my confirmation, which is enough for me then to say this was really an end of month, and we can go the other way around. Because again, I repeat, for those joining us really late, that I do reckon a lot of this is end of month. Another one. Canadian, yeah, we're pushing up in the euro CAD. The issue I have with the Canadian dollar is that oil is starting to come back down, and that McClem is really slowly starting to turn that hawkish tanker around. And I'm not saying he's doing 180, but again, yesterday he was confirming that the hikes are passing through and are starting to weigh on activity and stuff. So he is gradually turning around, and I reckon that that could have an impact on the Canadian dollar still. So I'm less tempted to counter trade this one, although we are coming into again interesting levels on this. This could actually cap just because the euro is losing its bit later on, for instance. But there's one that I'm keeping an eye on as well, and that's the euro kiwi. Seeing a bit of the resistance here, seeing here those prior tops, and we are starting to push against it again. This is one high, this is the other high, and we are trading around 182.25. Pips in euro kiwi are fast. Okay, I mean the kiwi pips, if you look at it, are, even though the kiwi doesn't represent a lot, but the pips are going quite fast. So it doesn't need a lot of change in the dollar in the dollar pair to change this pair quite a lot. So it is possible that we are pushing through even through the trend line because it's just fixing related, and fixing doesn't care about pictures or text. They just have to execute it. So it's possible we are going to have a look up here before the day is over, but there I'm going to be getting quite interested again. Let's just take a quick look on that euro yen though, because of course the Bank of Japan has thrown a bit of a spanner in the works for the yen longs. So here, this is the one, the 167, and we're bang on it. It's the 127% of this move here that we saw. This big move lower that we saw is the 127% of that one. That is coming in around 160.70, and we're bang on it. But then if you zoom out even wider, so we are through this long-term trend line that I was talking about in the days where it was trading around 155. And if you look at it, the really long term, if you look at it from the F.A.C.E point of view, there's not a lot that's going to stop this from testing the 38.2 if we don't see any interventions. Okay, bit early to call it back to 2008 levels. That would be something if we make it up there. But if it would be only me, I don't think the euro has the power to get up there. But then I've been wrong in the past as well. Cable, I know people are looking at the cable. We are through this bit of resistance here, short-term resistance 121.60. We're coming up to the next level of resistance right around the 122. 122 figure 20. I reckon that's a bit of an area you have to watch. Could also be that this trend line is coming up there right close. Yeah, the big one is still 123, 120.80. Okay, or give and take 10, 20 algo pips. I don't think that there is power enough to get through it. That may be something for later in the week, depending on what the US Treasury is going to do, depending on the FOMC, NFP, etc., etc. I'd say if we get up to this 122.20 come 4 p.m. or so, watch the clock, watch what's happening right afterwards again, because if we look at the differentials, they have rebounded just slightly, but they are still not supporting a bigger rebound in the cable. Okay, if you look at and I'm going to stop with that there and then. If you look at the euro differentials, they have also rebounded back a bit yesterday, and then also a little spike after the US Treasury funding needs plans. But they are also still hanging relatively low, relatively wide. So keep an eye on that again come 4 p.m., I would say. Ryan, are you back in the meantime?
Yes, mate, I'm back. Yeah, sorry about that, folks.
No problem.
The call was supposed to come after the show.
Yeah, I'm going to give it back to you then. Again, yeah, Gav, good reminder. I need to watch this. Euromex. So if my theory, again, if my theory is correct, we have seen those resistances here. If we get some more euro demand, and okay, this is just my bias. Don't do this at home, I would say. But if we get like a push up to here again, if it's combined with yields that don't push too much further, and looking at my bias in the euro, I will try this time. I haven't tried it last time, but I will try this time to see if there's anything to do if we get any closer to those levels. The stop is pretty clear. Once we get above the prior highs, no use to be short anymore. But yeah, I think there's nothing that tells me in the European data that that the euro should be moving too much higher. With that, back to you, Mr. Ryan.
Thank you very much, mate. Yes, we shall call it a day there. Just having a quick look at what's coming up for the rest of the day. We've got some Q3 employment stuff from the US, Canada GDP, and then some Case-Shiller HPI. And later on, we have the US consumer confidence numbers, and keep an eye on those inflation expectations. All good numbers to go into the Fed tomorrow with. Thank you very much, Kay, for all your valued input. I hope we've steered you right about what's going on in the Bank of Japan. Hope things aren't as clear as mud right now, though they still may be a little bit muddy. Watch that price action. It's going to be determining what happens next, whether we're going up or down in dollar yen. Have a great day, everybody. Trade safe, and we look forward to seeing you all tomorrow. Well, actually, you won't see me because I'm off finally for my bet lunch with Mr. Michael Brown over at Pepperstone, who bet me that BOE rates wouldn't go to 5%. I'm finally claiming my lunch, so I'm out in town tomorrow. So I shall leave you in the capable hands of
who signed off. Who signed off on that absence? I didn't.
Well, it's on the chat, mate. Don't give me all that.
Who signed off on your absence? I didn't.
I forged it.
Enjoyed it. Yeah.
Anyway, thank you very much, everybody. Have a great day today and tomorrow, and we'll speak to you later.